Thank you, Fred.
Thank you, panel.
Yeah, thank you.
So one more panel, and then we break and do breakout to explain what that's all about. But Barbara, who is, she was an All-American in 2 sports. She went to the wrong school, but we'll talk about that later. Stephen Burke, there he is, and Brian Cohen, who's the founder of the New York Angels. If we had, Tim also was in the Angel community here. We didn't talk a word about that. Stephen Burke, if you don't know, every Tuesday at 11 o'clock, wait for Tony, just 1 second, just get everybody's attention here. Every Tuesday, 11 o'clock, 250 weeks in a row, Stephen Burke, during COVID, he's on the week before Russia invaded Ukraine, he got it wrong, but he's got a point of view, shows the bulls, the bears, so he's been a great anchor man for our community. But we're gonna start with you, Barbara. How you see the markets, and she's on CNBC once or twice a week already, so you get sort of a sneak peek. And if you go play pickleball with her, she'll tell you even more. Brian, how you see the world as a sort of venture capital guy, and then I'll let you clean up. Go for it.
Alrighty. One of the things Mark and talked about is just where we see the risks, where we see the possibilities for the coming year. My specialty is really stocks, and I focus primarily on U.S. And right now, and I'm sure Steve has a great point of view on that too, but I think U.S. stocks are still the place to be. There's obvious concerns about valuation, and there have been for the last year, but I think given our economic fundamentals, inflation has come down dramatically from a high of 9% a couple of years ago to hovering around 3%, kind of been stuck there, although the most recent CPI and PPI numbers about a week ago were pretty good. They were better than expected. And so you've got consumers, corporations, their balance sheets are in good shape, things look pretty good. However, there's a few wild cards out there, and I'm sure this last, since the inauguration, you're seeing a flurry of activity from the new administration. And there's there's definite pro-growth things that are happening or they'd like to see happen, and there's some other things that could be inflationary. And so there's big concerns because we don't have real clarity. However, the biggest ones on the increasing inflation possibilities, and I'm sure you're all well aware, but that's really not only mass deportations of workers, which could be longer run inflationary because we have not exactly had a surplus of workers in this country, but and so the other one is tariffs. And there was some encouraging news or perception of it this week with the inauguration speech. The president did not make tariffs the top focus, and indeed he seemed to back off from his threats of 60% tariffs on China to maybe 10%. And so, but that's still a really real threat, and we don't know how it will play out. He's talking about Canada, Mexico, they're coming back and saying, you start that, we'll start it too. And so that is all very uncertain because, increasing tariffs obviously will raise the price of certain goods, many goods, and likely to hit the lowest income, and that's where the Fed, I think the Fed, right now the consensus seems to be, and the Fed has indicated they could cut rates 2 more times this year, but that's not a surety because we want to see what happens. We have a big PCE, that's the Fed's preferred measure next Friday coming up. We'll see what happens, and we're not going to know about tariffs for a while. But that would probably have the most immediate impact. Now, the pro-growth side, you know that they would love to cut corporate taxes even more. It was cut from, I think, was it 35% in Trump's first term, down to 20%. I think they'd like to take it to 15%, but that's not until year end. And, it's much more likely, in my view, that rates will be renewed, probably not cut, but we'll see, because there's going to be lots of talk about the deficits. So that, and the pro-growth, there's a lot, if you followed in the news out of Davos this week and what happened, also in AI, that was the talk. And you saw the Stargate news information that's going to be probably $500 billion coming, being invested in the U.S., and then there's a Saudi Arabian possibility. We don't have a lot of detail on that yet, of some $600 billion invested in infrastructure. So those are all clearly pro-growth. And plus the AI, what's happening there is so real and so powerful. And you're going to continue to see productivity increases. We're pretty much back to the productivity growth where we were pre-COVID, and it should continue because we're still really early on the impact of what's happening there. So there's a lot going on that's positive. We do, I think, have the strongest economy in the world. Again, the valuation is a question, but earnings, the banks started off with a bang, the big banks. A few weeks ago, that always starts the quarterly earnings. And in aggregate, the big banks were up some 26%. And of course, they're a bellwether on the economy. And with one other important thing of the Trump administration is the promise of less regulation. And already, those of you who are involved in the capital markets and investment, and I'll wrap up, I don't want to take all the time here, know that what's happening in the deal pipeline is getting ready, and there's going to be a lot of capital markets activity, and that's going to be a real positive for the markets. You'll see much more coming out. So it's going to be an interesting year. I think you're going to pick your points and where you get in. And again, I'm talking publicly traded securities, and there's obviously lots of opportunities that you gentlemen will talk about in private markets. But I'm pretty sanguine about the U.S. market for the year for those reasons. So.
Great, thank you.
So I always love being on panels with other asset classes because my class, venture investing, super angel investing, is the only one you have fun with personally. It's the one you get most involved in, and it's the one that I always talk about as a real contact sport. First, I have to just take note. I've never really been on a panel where my colleague compliments me on my son before I get here, before I walk in the door. So my son was just making sure to say hi to you and thank you for coming.
Good guy.
So thank you very much. Anything you want, just say nice things about me.
But one thing I like about your family is that you have, your sons need to start a business.
Well, that's part of the conversation. I know nothing else other than entrepreneurship. My college professor getting my master's in science journalism at Boston University many years ago said to me, I'm going to give you the best advice. Never work for somebody. It's the closest thing to slavery. I didn't know what he knew, or I didn't know what he meant, but I never ever worked for anybody. And so I've never received a paycheck. So my entire 50-year career of being a seed investor, being a venture investor, and being an entrepreneur, having built multiple companies and sold them, has been all about just the vision of the future and being able to create it. So everybody else invests in other people to find ways to get 5%, if they can, maybe 8%. The only thing in my life has been building companies to sell for multiples beyond any possibility of people talking about having your own private business and being able to sell it and make a lot of money. That is the way, by the way, to create your family office, which I've had, which my children, all who had to start a company before they were 26. My son was on Shark Tank. He's the one that you know. He invented a product that you can have college students have clean sheets anytime they want by having a 3M peel-away sheet on top of another sheet, 7 layers. It was just fascinating. And my other two children have already exited. That's the magic, of being in the entrepreneurship business. Exiting. When people ask me what business I'm in, it's not the investment business. I'm in the exit business. Okay. So I've shared with you the fun and the joy of being in the business, both as a family, as a father, and to you as the only asset class that you actually have fun in. I run research programs all across the angel environment, thousands of angels, and I always ask them, why do you do this? And the answer comes back, because it's fun. I enjoy being able to work with these young people and have them build companies that are going to be the future, whatever that future may end up being. Now, let's talk about what's going forward. AI, Chinese, announcement yesterday about DeepSense just changed everything. They created a product with its own LLM that outperformed all of the LLMs that anyone has put out by Google, Amazon, anyone who's trying to do it in any way, shape, or form has already spent, or getting to spend, $500 million, $500 billion. They did it for $6 million. And they did it with old NVIDIA chips. That is the beauty of the venture investing business. Being able to take a little bit of money and turn it into a lot. What has been the problem? ZERP started the problem. It created this incredible amount of money that was just out there for free. I can't compare the rest of the time after that because that was an absurd period of time during ZERP periods. Liquidity is the need. We haven't had much liquidity, so people are getting really soured on it. Family offices that I talk to, that I lecture to, say, Brian, listen, we want to invest in the future, but we can't get out right? Because venture investing takes anywhere between years, to be able to get you liquidity. And that's true, because it takes 10 years in the average venture investing world to do that. What's happened in the venture investing world now is that emerging managers like myself, who are running now new venture firms, I have venture firm investing in Israel, is finding it difficult because most of the venture money is going to Andreessen Horowitz, which, if you didn't know, literally in the venture business gets 70% of all dollars right now. And the top 30 venture investors and venture companies are getting up to 80 and 90% of all the money. So we're hopeful that where the opportunities lie is for you to think about investing in funds where there are emerging managers. Younger people who can see the world through their own opportunities that they see in the not older eyes of risk and adversity. Yes, venture investing comes with risk, a lot of risk. But if you're working with smart emerging managers, which I am, a person who wants to say, hey, those are the people you should check out, find them, research them, they're the ones who are investing in the future. And they're going to take you, as I have seen it, running the New York Angels with thousands of members over the years, there has been a constant flow of joy and happiness of making those investments into these companies that bring them the kinds of opportunities, not just financial, but remunerative and more
Let's talk
emotional
about
ways.
failures.
What about
It's not
failures?
always joy, right?
No, I said risk.
Yeah.
No question.
So how do you look at it? Because my problem is I invest and I get so emotionally involved and I never give up on them.
Of course.
That's why
That's
fine.
right. That's right.
Because I think I can change anything. I can make it work. The founders will get back together. But what's your, let's say, your pattern recognition for failure?
So, all right, Walter Cronkite, we always used to ask what was news, or was ever Walter Cronkite said it once. Okay, great. So I was a trained journalist. So as a trained journalist, and if you look at some of the best venture capitalists in the United States, I'm talking fast because I have so many hours of input to share, they turned out to be journalists who ask all the right questions, dig deep, don't believe a lot of BS, and really learn to understand what the real value is of the founder. I'm a seed investor. I only invest as the first check into a company. That's it. And there is nothing to do due diligence on, and I call it DO diligence, not DUE diligence. I look for reasons to invest. What's the pattern recognition? Long pause. Everybody asks that question. Can this person actually do it? That's it. Do you believe that this person has the ability to execute? That's it. The idea, I'll take a bad idea executed brilliantly anytime. Does the founder have the ability to actually do it? Can they make it happen? So I had breakfast, lunch, and dinner. I wrote the book on angel investing. It's all in my book. First breakfast, who are you? What are you thinking about? What's your life about? Are you happily married? I want them, by the way, to be happily married. That's another, and most of them don't play golf. I'm not. So they can spend more time. They can spend more time working. So maybe that's one of the little pattern recognitions, right? It's that sort of solo thing. I'm also interested in another pattern recognition. Are they funny? They better be damn funny because it is really hard. And it is going to be many, many moments of challenges that are going to have to find some humor in what they're doing. So if they can be sarcastically funny, I know that sounds weird, but I have this deeper inside baseball understanding of the behaviors of what great successful founders are like. And if they're not actually there yet, are they coachable? That's number 3. Can they be coached, or are they filled with the ego and greed that forces them not to listen to anyone else on the outside? Those are the things that really matter most. Is it an exitable company? That's another pattern recognition. We invest in companies because we get emotionally involved with the founders and think that what they're doing is, well, that word, C-O-O-L. No, I define it K-E-W-L. It's a different kind of cool. We fall in love too quickly, you want to help them and so on, and that's fine too. And that's part of the time, because the average angel investor, venture investor is over 50, 60 years old. Now we're getting a new young crop of people into the marketplace who really want to really fulfill the destiny of being in a relationship with these founders. So those are the things that matter most. Obviously terms, valuations. We've been stuck with insane, absurd, ridiculous valuations. I was the financial founder of a company called Pinterest. It was $1.5 million valuation. That's unheard of these days. So it's really hard to stick to your principles. My best friend Howard Morgan, one of the great investors of all time in the business, he gave me the input. If you see FOMO, fear of missing out, walk away. It's going to cause you to make an emotional decision that you're really going to regret later. So there are many things to describe I really would love good questions that you have. It's part of the joy I have being in this business for 50 years is sharing the wisdom that I've gained learning from a lot of very great people. Alan Patricoff also being one of my longest, oldest, dearest friends, the father, grandfather of venture investing. So, that's right. Thank you.
No, that's great. Thank you. I agree with Barbara. U.S. stocks are overvalued, but I think they're going to continue to do well for a couple of years, ironically. And that's because of the policies that we have of capital flowing back to the U.S. from the new president. I think the U.S. and China have a debt problem each, and that's going to be weighing on the system for some time. They're not alone. The UK has one. Europe has different issues that are going to slow them down. So we basically have a world that we're getting overwhelmed by climate. We have multiple conflicts going on. We have too little growth, too much debt, and rising demands from populations. So that's the backdrop that we're looking at. But again, the innovation that's coming is unlike anything we've seen. That's going to drive new opportunities. We adjust to the problems that we have, although I think the one thing that leaders have to start acting on all over the world is managing their debt burdens, because whether it's the US or look around China, we all have too much debt and not enough growth. I also think the thing that Brian said that's really important is we are no longer going to be in a zero interest rate environment, and that changes everything. All the stuff we learned over the last 15 years, you have to forget, and you have to go back to everything that you learned before basically 2000, which is the world works on earnings and it works on rates. And if you understand that and understand where the outlook for corporate earnings, interest rates, and inflation are, you can succeed in any environment. That's really the thing that we're looking at. And I would say the last thing is follow the money. The money is telling you where investment is going. And right now, investment is fleeing China and it's fleeing Europe and it's coming to the US. And that's really about the policies that are in place and the threats that have gone on. That won't last for a while or forever, but it will last for a little bit of time now. And I think that's going to drive the US forward for a little bit more. So I'll stop there.
Great panel. Let's open up.
As you know.
Just introduce yourself.
Jay Newman, the Athens Group. I'll be speaking tomorrow, but it won't be as exciting as these past panels. You guys have been terrific. You keep touching on something that's really got me concerned, because I'm very sensitive to interest rates because being a real estate developer. And this situation with the deficit to me is a game of musical chairs. And when that music stops, I have no idea where it's going to go, but it's not going to be good. And you have an administration that I think is going to utilize or accelerate the deficit spending or the deficit increase, whether it's going to be more tax cuts, whether it's some of the other policies. So when does it stop? And I know no one can predict that, but it seems like we're getting closer to that moment. And so everyone's feeling good that this should be a good year, the next few years should be a good year. But if eventually you can't finance those deficits, that means interest rates pop, and that means recession or a great recession. So just your thoughts.
Oh, starting with an easy one. Thank you. Listen, we can go longer with debt and problems than you think.
Keep the mic up.
Sorry. We can go longer with debt and problems than we think, but Ray Dalio was out yesterday in Davos talking about the cliff that's coming and how we have to start addressing it. And one of his suggestions is actually very reasonable. If you attach to what Doge is trying to do with a slight tax increase and get ahead of it early, and that's not what anyone wants to hear, but when Trump cut taxes from 35 to 21, the OECD average was 25. So he just went too far on that. All we had to do is be equal. If you think the US is exceptional, you don't have to go below to attract capital. You just have to be equal. So I think he went too far when he didn't have to then. And that 3% or 4% would make a huge difference in the revenues that we're generating. So I think we're going to go back to the old Simpson Bowles thing at some point and have because it's going to have to. You can't, each party can blame the other one, but they're both at fault. So that's where you're gonna get to here. I think in China, their issue is different, and they have to figure out how to get their consumption up to a reasonable level so that they can offset the strains that are on their system and get better balance. So I think those are the issues that you have to say, and neither US or China is doing the right things to get you there. So we're getting partially there with Doge if they could do it, but you need to raise taxes, I believe.
Yeah, I would agree with that, because if you look at the spending of the US, we bring in about 5 trillion in revenues, but we're spending about 7 trillion. And if you look at that 5 trillion, about 5 trillion is 4 trillion goes to Medicare, Medicaid, and veterans benefits, and then another 800 billion to defense. That doesn't leave a lot left there. And so where's the discretionary cuts going to come? We will see, but it'd be very tough to cut Social Security and Medicare, for the American people. But looks like it's going to be tried. We'll see. But I think the only solution is taxes. I mean, that's what the tax cuts have really hurt the budget. But we will see.
So
We'll have a different opinion.
Mo, your brother, you didn't know, Mo Cohen.
We're all cousins.
Yes. Has a question about exits, or a comment or a question.
Yeah, just a lot of the clients, my name is Mo Cohen. A lot of clients I've been talking to, obviously over the past 3-4 years, exits have been a struggle. And I think you alluded to that. The IPO market's still not where it needs to be. Funds are coming towards expiration. Thankfully there are now secondary markets, I guess, for securities, private securities, which has opened up, which I think has been great.
That's true.
For that market, but it's still lagging. I just don't see how it changes over the next, call it 6-12 months. But something has to be done, I guess.
Well, I don't think there's anything we can do. I mean, we're in the business of creating the future, not sort of like creating the ways to buy into the future through acquisitions, M&A, or IPOs. But I'm a rational optimist. I think we all want to be a rational optimist. It's hard not to. I don't think I'd ever sit on a panel in Florida and hear 2 people say, raise taxes. So I'm kind of like in a stunned moment right now. I'm a little shocked. I don't think about that, because all of the money and all the wealth I've created for me and my friends have all been through the world of venture investing and being smart money into smart founders, period. Hands down, that is the equation. Smart, scalable founders. That word scalable is important. So I can't say that, other than I think that venture investing is a hedge against, all the issues in the future. Because it's always going to be an opportunity where, when you look at the greatest companies that exist today, most of them were venture financed, right? So it's about being a great picker, it's being a great believer, and a great forecaster. And
You also mentioned that you are an investor in exits.
Absolutely. I always ask the question, how are you going to exit? It is, and I've debated this on stages throughout the world, why would you ask a founder after they've been in business for less than 6 months what their exit strategy is? How dare you do that? And I said, no, that's the business I'm in, right? When you start looking at the world in reverse, everything changes. Is this an exitable business, or is it a family-run store operation that's a lifestyle business? That's not our interest. So it's not about falling in love. It's about being a principled investor in the venture space. And I would ask each of you to reconsider any issues about concerns with risk, about just read my book on how to be a smart early stage investor.
So I guess to Jay's question related, what you talked about, Stephen, what's going to get us, what's going to solve this? It's usually productivity. Mm-hmm. And that goes to scalability in some ways. Curious, of course, AI is an enabler. We've been hearing about it. There's huge revenue lift on it. Maybe just touch on that.
Well, interestingly, I think Barb touched on this. When we started giving away money, when the pandemic hit, we started losing productivity. You're giving people money to do nothing. That does not improve productivity. It's the opposite of improving productivity. So zero interest rates actually funded so many bad ideas that were designed to solve a problem, but the problem they were designed to solve was to offset debt by raising asset values, which worked, but we went too far. So we should have cut a lot of the spend years ago. The government shouldn't have thrown as much money when they did. And now you have these interest rates that are going to make exits a lot harder. So the answer is you're going to have a rationalization of the seller coming to realize that his dream wasn't going to be realized at the value he thought. And the buyers are going to have to realize that they can hold out for so long, but at some point they're going to bite the bullet too, if it's a good business. If it's a bad business, you're going to be out of it and people are going to just lose. So I think that's it. I think if we have 4 or 5% interest rates, changed everything, and now people have to rethink what they're in, how do they get out, and where are they going next. And to me, I think you can specialize in an area, as we heard from Brian, or you can asset allocate really smartly. I don't think we've had an opportunity to smartly allocate for a while because of zero interest rates, and now at 4 and 5% interest rates you do. Right. And I think that's the game changer, and that'll get us back to a more normal approach to investing. And you'll make money and lose money the same way as we did in the past. Bill?
Indeed. Good to see you all. So, Bill Eichler, pension trustee. Question for the public market folks. And what do you think about the value growth conundrum that we've been in for a while and concentration? And then I also have a follow-up question for Brian separately.
I'll go first. I think there's, let me put it this way. The outcome of the markets going forward for returns will be determined by the level of interest rates and how much the broadening out goes. Because I think it's going to be, I think that the Magnificent Seven are spending at a level that's going to be fine for them. And it's going to create a lot of opportunities for some companies. But if they don't get the return on that, then the rest of the thing becomes a little bit of a house of cards. And if you have interest rates 4.75 and up, and certainly if they hit 5, then I think you see a lot of the broadening out go away. And I think you end up with the broadening going from 7 to up to 50 maybe, but not beyond that. Because I think the finances of a lot of these companies are not well positioned to deal with higher interest rates at all. So that's my view.
And on the growth versus value, my view, a lot of so-called value stocks are just lower growth stocks. And that's why there's been a real disparity for some years now in the returns on growth versus value. And you talk about the concentration in those top 7 names, or even if you look at the percentage that the top 10 make up of the S&P, that could very well continue for a while because it's about their earnings growth, which is sustainable. And Steve mentioned an issue that a lot of people wonder, well, where's the return on investment and all this AI spending? Well, you're already seeing in names like, excuse me, in Meta, who is already realizing incredible ad efficiencies and engagement because they have really been deploying it. And you will start to see this across many companies. But I think that concentration could continue. And what you saw last year happen periodically, like after Trump got elected, all the the Trump trade, so-called, industrials and all that roared ahead, gave it all back in December, because you're seeing a constant rotation. People want to get into this market. It is a bull market. So you'll run up one area, like even the big 7 FANG names, or the big mega cap tech. They'll run up, that'll be a source of profit taking, you'll rotate into another area that looks cheap, then those run up, you rotate back out. That's been happening even the last few weeks, we've seen that. And this week we had a big move in the market. One day it was all driven by the mega cap. Next day, those sold off a bit, it was the industrials. So I think that continues, but I think the mega cap names that you're talking about, if they will continue to outperform because the earnings are there, and they probably could accelerate, depending on the company.
Yeah, the gorilla in the room, the undervalued gorilla in the room, and Gartner Group just sort of did their analysis the last couple of days, and you all know this. 20% of the middle management will be cut next year, and we're already seeing that. And where are all these people going to go? Right? There's going to be no jobs. I've seen this, and we all watch it now. Meta keeps cutting. So among the Magnificent Seven, they've got most of the fat, and they're just going to keep cutting until they get the efficiencies that they expect. But the agenetic world is upon us all. And if they took down a video that had Eric Schmidt talking about what the impact of the AI bots are going to be, and it is going to be profound. There's that great line: prediction, especially about the future, is really hard. So I don't think anybody really knows So we can pontificate all we want about the possibilities and what downside is going to be. But I think there's going to have to be that payment made to people who can't get jobs. What do we call that? Andrew Yang was the guy who was out there in front when he called me from, when I was driving on the New Jersey Turnpike. He said, "Brian, I'm going to go run for president." I said, "Are you really serious?"
Cool.
I thought he was nice, of course, but he made it to the stage. But he was right. There is not going to be enough jobs for the people who are going to be let go next year, 2026.
Well, the optimistic view on that is that you'll just be retrained for other jobs. That's
Oh,
certainly what
yes,
tech
whatever
is.
those may be.
I just want to give a quick
Just like
anecdote.
the green
I recently had Harvard Business School reunion in the fall, and our last, there's a couple days of lectures and what the leading ideas are, and the last one was on AI, and it was in the biggest auditorium, and it was standing room only. And let's just say, after that presentation was done by a professor going on the massive changes that will happen, everybody in my section just looked at each other and said, "Good thing we got jobs when we did."
Right.
Because it is going to change things big time.
MJ Gottlieb, Lucid App. Steve, you look great.
Thank you.
Question to bottom line versus the double bottom line. Brian, how do you look at social impact? Because you talked about, you look at the entrepreneur and say, is this person going to succeed? What I've found, if there's a reason why, that purpose, I've never seen anyone go through, the peaks and valleys more than a social impact entrepreneur. So I'm interested to know your thoughts, what you look at with regard to social impact, and then the other thing is, why just first check?
Yeah, well, the first check is the one that I have the most connection to, because that's when you can make the most, impact on on the founder themselves. There's no one else in there, sort of like dirtying the waters, saying I'm smarter than anybody else. Here, listen to me. So I know that in the years I've been doing this, it's where I've had the best impact and the best return on time and results that I've gotten. Now, the issue about social entrepreneurship is a completely different conversation. It has nothing to do with capitalistic venture investing. If you try and marry the two, they don't work, they haven't worked, there's no real good examples of it working. Certain companies may have better return on getting people happier, right, because of the businesses that they're in, but not really for a venture investor. The venture investor is a capitalist, they're interested in huge returns, right? Anyone in the venture business knows, everyone knows. You need just one multi-billion-dollar, return to return your entire fund. If you don't get that, right, your LPs are going to walk away the next fund you're building 2 to 3 years later, right? So social passion has nothing to do. When people said, follow your passion, that was the worst thing they could have told people to do. Passion doesn't make you better at balancing your checkbook or knowing how to sell the next customer. Good determination, grit, and smarts does that.
You're just dropping the mic on that one. So, all right, we're at the state 17 minutes behind. We're gonna take a break, but come back here in like 5-7 minutes. Let's say it's, if you can, by 3:40, 6 minutes quickly. If you're interested in Florida, Naples, that's gonna be this area right here. If you're interested in venture, or private markets, will be over here. And if you're interested in the public markets, that'll be where Barb's nodding her head. Those 2 tables. So, Florida, venture privates, public markets. Take a break, come back, and I'll annoy you to get in those circles.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.